All right, let's just dive right in. If you're running an international business or, managing cross-border capital, you've probably felt it, that underlying anxiety that the financial infrastructure you rely on is actually incredibly fragile. Well, today we are unpacking an anonymous, highly detailed expert report that deconstructs a massive systemic issue. We're talking about why international entrepreneurs are suddenly facing these devastating account freezes. But more importantly, we're going to break down how you can strategically build a truly resilient cross-border financial architecture. We are skipping right past the generic customer service complaints today, folks. Instead, we're looking under the hood at the hard, underlying algorithms and compliance structures that literally dictate where and how your money can flow. So consider this your absolute masterclass in mitigating systemic cross-border risk. Here's our roadmap for this explainer. We'll hit the account closure crisis, explain the financial institution tiers, dig into the mechanisms of risk assessment, evaluate viable EMI alternatives, and cap it off with advanced strategic routing. Part 1, the account closure crises and the systemic triggers directly impacting non-US residents. So let's establish the baseline problem here. When thousands of non-resident founders suddenly find their accounts frozen, literally out of nowhere, the general public just kind of assumes it's a random glitch, right? Or maybe a localized customer service error. But I'm telling you, it's absolutely not. While a lot of the popular digital payment platforms out there are functionally fantastic and have these beautifully user-friendly interfaces, their underlying compliance algorithms are completely unforgiving. A sudden freeze isn't a mistake. It's a highly predictable automated defense mechanism. It triggers a compliance lock that can completely cripple an international business's operations overnight, literally overnight. And if you want to prevent it from happening to you, you have to understand exactly why that algorithm tripped in the first place. Moving to part 2, financial institution tiers explained. We really need to deconstruct the banking landscape. To truly grasp why these sudden freezes happen, we have to start with one absolutely critical definition: the electronic money institution, or EMI. So what is it? Basically, these are authorized financial intermediaries. They hold funds and they seamlessly facilitate multi-currency transfers. But, and this is key, they do not function as traditional chartered banks. They are strictly money transmitters. And because they don't have that traditional banking charter, they have to operate under distinct and, frankly, much stricter regulatory rules regarding how capital moves across borders. So their functional utility for you as an entrepreneur is incredibly high. But their internal tolerance for structural risk, it is basically zero. Now, let's break down this structural reality, because the landscape is rigidly divided into tiers. Tier 1 institutions are your traditional physical banks holding their own exclusive charters. They have the absolute highest compliance thresholds and are deeply embedded into national networks. Then you've got Tier 2. These are often those slick, online-only fintech platforms, but structurally, they're really just digital wrappers built directly on top of those Tier 1 banking networks. This is huge because it means Tier 2 platforms completely inherit the rigid compliance limitations of their Tier 1 partners. If a Tier 1 bank's internal algorithm flags certain foreign jurisdictions as high risk, the Tier 2 platform automatically blocks them. No exceptions, no human override. And then finally, we have Tier 3, which is where our EMIs sit. They're highly agile for multi-currency routing, sure, but because they sit outside the traditional charter, they rely heavily on extreme, high-volume algorithmic compliance just to maintain their operational licenses. Part 3, mechanisms of risk assessment. Let's look at the specific triggers that escalate compliance scrutiny. So now that we see the architecture, what actually triggers the alarm bells? Well, the expert analysis identifies a massive red flag. Think about a direct international wire from a corporate entity straight to a personal account overseas. To a traditional compliance algorithm, that action absolutely screams capital flight, tax evasion, or just improper documentation. It is an immediate trigger. But if you look at a mitigated risk approach, you take those exact same funds and route them through a dedicated Tier 3 EMI intermediary first, before distributing them locally. The cause and effect relationship here is undeniable. The EMI acts as a vital structural buffer. It seamlessly translates a high-risk international wire into a normalized, localized transaction, which keeps those highly sensitive Tier 1 algorithms perfectly happy. Here's another massive algorithmic trigger that the report defines as pass-through behavior. You might have heard of this. It's the highly scrutinized practice of receiving a large capital deposit and immediately wiring it right back out, leaving the account with a consistent zero balance. Look, make no mistake, financial institutions absolutely despise pass-through behavior. Their internal risk models automatically flag this as incredibly suspicious because it closely resembles traditional money laundering typologies. To satisfy the automated algorithm, these institutions require you to maintain resting operational balances. You have to demonstrate consistent, varied transaction activity. You literally can't just act as a hollow pipe for capital. So, the golden question: how do we actively outsmart the algorithm? Well, first off, stop scattering your supplier payments across 5 different accounts. That just unnecessarily multiplies your risk footprint across the entire financial system. Instead, consolidate your high-risk international payments into one single, dedicated intermediary account. Why? Because if that specific account gets flagged, your primary operating capital remains safely isolated elsewhere. Next, limit large, unnotified cash withdrawals. Those almost always trigger a manual review. And absolutely crucially, maintain a healthy operational balance at all times to definitively avoid that pass-through algorithm trap we just talked about. These actionable steps are precisely how you build true systemic resilience. Part 4. Viable EMI alternatives. We're evaluating platforms well beyond their shiny marketing features. Let's look purely at operational utility to find viable alternatives for your capital. The report identifies Archetype 1, the strict compliance competitor. This type of platform functions as a highly capable alternative across multiple global jurisdictions. Now, its defining trait is a very high barrier to entry. They offer vital tools like corporate debit cards, but they strictly demand elevated resting account balances and manual approval processes just to issue them. The initial compliance checks are rigorous and, frankly, probably pretty frustrating for an entrepreneur in a hurry. But the implicit analytical trade-off here is crystal clear. Once you successfully pass this high barrier, the back-end routing offers extreme stability. They heavily weed out the operational risk up front, which fully protects you from sudden freezes later down the line. Then we have Archetype 2, the B2B powerhouse. This specific platform type focuses heavily on providing virtual bank accounts across multiple major currencies. But the real analytical insight here is its unique operational capability to provide a dedicated US dollar wire account. For a non-US entity, the ability to effortlessly accept a direct B2B wire in USD from a global enterprise client is an absolute game changer. Plus, these platforms are usually deeply integrated directly into the payment ecosystems of major global marketplaces, and they often allow for direct, zero-fee tax and VAT payments to regional authorities. That entirely bypasses those costly secondary currency conversion fees that silently eat away at your margins. The analysis also highlights specialized and regional solutions. For instance, there are platforms highly optimized exclusively for entities operating predominantly within the EU zone, heavily leveraging ultra-fast local payment rails. Others have proven utility for handling massive e-commerce operations that require incredibly specific, high-volume supply chain routing directly into Asian manufacturing hubs. Now, while plenty of flashy emerging alternatives exist on the market right now, the expert consensus is absolutely clear. Your primary operational capital should strictly be trusted to established, heavily audited Tier 3 infrastructures. You really want to use the emerging niche players purely for specialized supplementary routing. Finally, Part 5, Advanced Strategic Routing. This is about fully optimizing the flow of cross-border capital. So how do we actually architect a virtually frictionless transfer sequence? Well, here is the exact operational playbook recommended by the report to bypass traditional red flags. Step 1. Open a USD-denominated Tier 3 account registered locally to your foreign entity. Step 2, instead of firing off an international wire, initiate a domestic USD to USD transfer from your primary corporate account directly to that new foreign EMI account. Step 3, from an accounting perspective, classify this strictly as an intercompany transfer. And step 4, finally, execute the conversion to your local currency domestically within that local jurisdiction. By executing this exact sequence, the money never actually looks like a risky international outgoing wire to those highly sensitive Tier 1 algorithms. The advantages of this intercompany routing sequence are honestly profound. First and foremost, it entirely bypasses the intense international wire scrutiny from those rigid Tier 1 and Tier 2 algorithms we dissected earlier. It's practically invisible to them. Furthermore, it generates significantly cleaner documentation for your official tax filings. You are establishing a crystal clear corporate audit trail rather than a messy, easily flagged personal wire. And lastly, it empowers you to retain total control over the ultimate currency conversion within a flexible, low-fee environment. You are mathematically optimizing your capital rather than losing substantial percentages to the hidden spreads of traditional banking. We'll end on this vital, synthesized insight right from the expert analysis. The security of cross-border operations does not rely on finding one perfect platform, but on architecting a diversified, multi-tiered financial infrastructure. That hits the nail on the head. What you absolutely must take away from this explainer is simple. Relying on a single point of failure, whether that's one traditional bank or one digital platform, is the true systemic risk. By deeply understanding the underlying algorithms and mastering strategic capital routing, you take back control. So, take a hard look at your own business right now. If your primary bank algorithm tripped today, would your company survive the week? If not, it's time to start architecting your alternatives.